Well, good morning. How are you doing today? Wanted to go a little earlier, you know, kind of play around with this thing, or you may not know. It's a nervous tick, something I had to get over. But um, last week I tried to come on, right at the start of the market. I said, again, that's a tick. I'm working on it. But I want to do it a little earlier because there's a lot of things that I have to get done right at the beginning of the day, as I'm sure you do also. So, big week for economic reports that affect the housing market, interest rates, things of that nature. So, without further ado, let's get into it. Let's see here. Here we go. Here we go. So, March 18th through the 22nd, as far as this week is concerned, today we're going to be looking forward to the National Association of Builders Home Confidence Index. So, this is what the previous read was 48, forecasting for 48 again. Um, Bottom line, anything 50 or higher, excellent, excellent sentiment. Anything less than 50, not so much. But as we see here, kind of went through this resource from Veta FI about the housing market index and the builder confidence, and it's risen quite a bunch, or quite a bit, if you will, since August of this past year. So it says the latest reading is at 48. That was from last month. Again, it's projected to be at that again today, but it's up 4 points from January and above the forecast of 46. Builder confidence rose a third straight month to the highest level, okay, since August, as a result of moderating mortgage rate and then the possible Fed rate cuts and a lack of existing inventory. So, as you hear us talk, or as you hear me talk about inventory really tells a story, and there's still a shortage. There's still a major shortage of inventory. So, uh, the National Association of Home Builders, in combination with Wells Fargo, okay, it's a housing market index. You can look that up. And again, if this is something that you're interested in and wanting to grow your knowledge, go in and read, man. Read, get comfortable with the report, how it's compiled, and how they go about getting the information. Basically, it's a survey. Okay, let's go back here. It says the data is collected from a monthly survey of about 900 builders, asking the respondents to rate market conditions for the sale of new homes at the present time and in the future for the next 6 months, as well as the traffic of prospective buyers of new homes. Okay, so this is a diffusion index, which means that a reading above 50, as we said earlier, indicates a favorable outlook on home sales. Below 50 indicates a negative outlook. So this report is below, but you got to look at context. Go back and look at history. It's on an upward trend. So confidence is growing. Okay. Let's see here. Buyer traffic is improving. Okay. Even small declines are as we see small declines in the interest rate. Okay. Um, it's going to produce a disproportionate positive response among likely home purchasers. Okay. But here it is. There's a lot of pent up demand. And so, for any of you guys that are out here, any of you realtors that are or talking to clients and have them on the fence, you got to stress the importance of all of the competition and the pent up demand and the lack of inventory. Okay. So, check this out. It says, with the future expectation of Fed rate cuts, okay, there's still some expectation of some cuts. Just have to wait and see. Uh, in the latter half of 2024, the National Association of Home Builders is forecasting that the single family starts will rise above 5% this year. So, single family, duplex, triplex, fourplex. Okay. Um, so, the chief economist, Robert Dietz, is saying, he says, and he is quoted as saying, but as builders break ground on more homes, lot availability is expected to be a growing concern. Okay, so the land in which the homes are being built on is there's a concern with that as well. So not only do we have enough, not have enough homes, the land in which to build those homes on is not readily available. Okay, all those things speak to higher costs. So as you're speaking to your clients, you have to let them know pent up demand, lack of inventory. If you don't have the land to build on, hey, you can't have the houses to build on. Moreover, and this is something that a lot of people don't talk about, not only the land is a concern, also the persistent labor shortages. So it's the same folks building these houses, man. You have all these different builders, and they'll tell you, hey, this builder is building X amount of homes. But if you get on the ground, boots on the ground, it's the same framing crews and things of that nature. So the builder might be the the big general contractor that puts all these uh, skills together and different companies together to give an ultimate product. They're not building. Okay, so the not only the lack of labor but qualified labor. If you're starting to listen, some of the big name builders are having quality issues, and you got to go back. Hey, that's a lack of skilled labor. So also make sure that you're educating your home buyers, especially if you're a younger agent, about quality. And if you don't have context to quality, you need to lean on the more experienced people in your brokerage or whoever you're associated with to make sure these folks are getting inspections, and these inspectors are catching things, because the workforce is not as skilled, in my opinion, and that's why you're seeing these news stories and things of that nature, from big, well-known builders that 5, 6 years ago you didn't hear this. So not only the quality of the materials you have to watch, because shrinkflation is real. These folks are eking and squeaking out profits, especially if they're on the stock market, right? They have goals that they have to hit. You have to make sure it's new or better. And to me, that's our job. Can't tell folks what to do, but on your side of the transaction, if you're a realtor, these are things that you can point out to your potential buyer and help them vet. Hey, maybe a home 2 to 3 years older, because quality and building standards were different, sizes of homes were different. And so this is how you can circumvent, if you're a realtor, a buyer's agent, the news that's out, the negative run of press about getting rid of buyer's agents or realtors in general, or buyer agents commission having to be paid by the buyer. Well, if you provide the value here of educating them on what a good home is, quality wise, that's a reason for you to be able to justify your commission. Just a thought, but I digress. So pent up, pent up demand, not enough homes. Now we have not enough land and labor concerns. All these things are headwinds, if you will, okay, and could cause home prices not only stay where they are, but to increase, because every 1% decrease in interest rate, we have millions, depending on who you follow and listen to. It's just a lot of folks that are ready to jump in. So that bodes not bodes, but that puts more importance on your buyers, or if you're buying, making sure that you're properly qualified and ready to go. Properly qualified and ready to go. You can't wait till the last second and think you're gonna, you know, get what it is that you're looking to get because of the competition. So anywho, uh, that's that. Home by home builder sentiment, looking for that. And then again, before we move forward, anything above 50, 50 or above, excellent. And this number has been increasing since August. So we'll see what that does here when it comes out. Okay. 10 year, it's going the wrong direction. Right. So if you are a buyer, if you have buyers, make sure you're in that closing window. To me, it's 30 days. I wouldn't play with it. Make sure that they're locking in. Made this call on Friday. Rates are getting worse. A quarter point here, eighth of a point there. You don't want to be the one if you're a lender out. Don't play Vegas. Understand these things and make sure you're communicating in constant contact with your clients so that you're not looked at negatively if the rates go different in a different direction. Uh, if you're within 30 days, I'm logging in. I'm not a gambler, and so make sure you're staying in communication. Realtors, other loan officers, and if you're a buyer, um, get with your lender. Make sure you lock in outside of 30-day lock window. This is what I would recommend. Um, Hit the QR code there and get a second opinion. There's a lot of costs that a lot of you guys are paying unnecessarily because you're not shopping. And so all these rules have been made for you to shop. So if you're outside of 30 days of closing or escrow and you have a loan estimate and things of that nature, you can shop. Not going to hurt your credit and things of that nature. All these fear tactics that people put into your mind when done properly. So we've created a way for you to get a second opinion. And I'm gonna have to put my reviews in. I help people all the time, and if you have a great deal and you're good to go, I'm gonna let you know. If not, I'll present some other options for you, and then you make the decision. But fear, long and short, is why most people, and not most people, most minorities, because you go with that one person that you think handles everything, and a lot of times that costs you. So I encourage you to shop. Okay, click the QR code, follow the questions, answer the ones that you have to answer, upload the loan estimate, and we'll let you know. Okay. So again, 10 year going in the wrong direction. We want this 4% or less, but it is what it is. So be abreast of it, stay on top of it, and make sure you're locking yourself in at the best rate that you can for right now with a strategy in place to refinance as soon as possible based on the loan type that you have. Okay. And then just a 10,000 foot view. Like I said, I like optimal blue pricing. Market's not open yet. So, but this gives you a good snapshot. Again, you're hearing a lot of stuff online 7, 8%. Rates are 7, 8%. They're going to be 7, 8% when we're doing non qualified mortgages. Uh, could be 7 in the 7%, for and 7, 8, 7% plus for investment type cash out, things of that nature. The more or the less documentation you bring, the higher the interest rates. But for your old 100s, your conventional loans are going to be the ones that are on the higher tier. If you got great credit and great down payments, just depends. Yeah, well, I'll say this: if you're putting less than 30% down, then rates might be higher than somebody that has a 3% home ready, home possible that fits in a certain area of median income because they've changed the pricing structure, the low level pricing adjustments to help those people get onto the property ladder. It is what it is. Um, but if you're a conventional person and has less than that 30% to put down, they don't have a great credit score, FHA is probably the way to go. Okay. But for conventional FHA, VA, USDA, you know, even with the move over the last, you know, week or so, as far as the 10 year is concerned, in an upward trend, rates are still under that 7% mark. So you're gonna be anywhere between six and a quarter uh, and 6.75%, depending on what lender you deal with and the cost that they have associated with doing business. That's why it's important for you to shop. So, yeah, man, that's it. So I'll let you guys to it. Have a great day. Make sure that you're making the best out of it. And remember this, man. You know what? I almost forgot. I want to give a credit tip. Credit tip. And this is something that you guys can use if you're a realtor, a loan officer. You'd be surprised. A lot of folks still don't understand. But the main, the most important part of your credit, if you're trying to establish or change a credit score quickly, it's really your utilization of your revolving lines of credit cards. Bottom line, it's equivalent to blood pressure. It's there. You don't really feel it unless there's a problem. There could be an ongoing problem if you don't monitor it. But utilization is the key. Don't care what anybody tells you. This is gospel. Okay, 2 to 9% of an individual credit card or your global credit limits. If you keep your utilization in that range over time, if you have the right credit mix and enough time, you will always have the highest credit score that you can have. If you're in process to buy, say you're within that 30-day strike window and you need to increase your scores quickly, your lender should be able to walk you through that with either a rapid rescore or just telling you, hey, pay these balances down to XYZ, okay? And it should give us this point increase to put you in a better pricing position. That's the quickest thing to do. For those of you that don't have any credit cards, you need to get one. The authorized user strategy is a good look, but you got to pick the authorized user wisely, and it should be a family member so that it remains on your credit as long as it needs to be. But that's not always the answer if you have a thin credit file, because you may still be a higher risk based upon some other factors. But I digress on that train of thought. The point is, utilization is the key. How you utilize your credit cards, your revolving line of credit, 2 to 9% is the gold standard. Obviously, less than 30% is where you want to be. And that's really where you can move the needle. So that's the credit tip for the day. You guys have a great day. Um, be positive, man. Say good morning. Say hello to people. Uh, put a smile on your face. Free to smile, and it does a lot for you physiologically. You'll be surprised. So, with that, my time is up, but I thank you for yours. As I always say, guys, let's be good to one another. Let grace abound. And until the next time, peace. You have a great day.